What are the largest institutions doing in commercial real estate in 2025? If you're new to commercial real estate or learning a new asset class, it's critical to watch what more sophisticated, larger investors are doing and apply it to your own investing criteria. Listening to smart people talk about commercial real estate is one of the best ways to learn. Institutional investments have a trickle down effect to whatever level you are investing at. If larger endowments and pension funds are buying more net leased, triple net, high quality credit industrial leased properties, their inventory is going to be lower and they're going to be looking to either develop more sites or they're going to be looking to buy single one-off facilities. And that will have an impact. There are regional players that will buy directly from you if the demand is there for them to package it up and even sell to the regional acquirer, and then they can sell to that institutional level. But at the end of the day, these massive impacts of cash flow do impact the commercial real estate market. In this video, we sit down with Cody Danks Burke. He is a former Cornell endowment, and he is now consulting on the private side. But what he has to say about the future of commercial real estate may change how you invest in the next few years. So check out this Q&A. We listened to him talk, and let me know your thoughts in the comments.
It's good to see everybody. Thanks for asking me to come. My background, just a little bit, I've had a varied career, but my career since 2004 has been focused on Cornell. I graduated in 2006. From 2006 until 2021, I ran the real assets portfolio for the endowments. Real estate, natural resources, infrastructure, public, private, equity, and debt. And then in 2020, I joined the faculty and began to teach in real estate courses. And then for the last 3 years, I've run our master's program. And so I'm a professor of practice at Cornell, which means I teach and run the program, but I also have to continue to practice. And so I do two things on that front. I invest the real estate portfolio for a family office based in Portland, Oregon. They don't need me full-time, but part-time. And so they have a portfolio of directly held and kind of club assets across different property types, mostly in the Pacific Northwest, but also Colorado, Nashville, and around. And then I also do a little bit of consulting for a general partner that was in my portfolio at the endowment that's based here in Dallas called Velocys, and they are a real estate private equity firm investing in different property types in the Southeast. So on the endowment side, I think a lot of people are trying to figure out what are endowments doing, what are big institutional investors doing in real estate. And as I think almost everybody knows, it's been a really rough few years, particularly on the private side of real estate investing, certainly on the equity side. Debt has been a good spot to be, but for a long time, most big institutional investors really wanted to be in equity. They wanted equity-like returns. And so it's taken a pivot for people to pivot, either pivot away from equity or certainly pivot part of their allocation of real estate toward the debt side. And it's been interesting. David, who's just graduated, David Chen just graduated from the program, as he will tell you that that shift is reflected in the hiring. We've seen a lot of students out of Baker, out of the graduate program Baker, but also undergrad into debt shops. And I think the pendulum will swing on that pretty soon. I think it's already starting to swing a little bit, but I think that is consistent with what's happened in a lot of portfolios. So institutional investors who had dry powder to invest in real estate, coming out of COVID, I think people really put a lot of money into debt. As I think you've seen, everybody and their brother, if they didn't have a debt business before, if they're in real estate investing, they certainly do now. And I think that we're starting to get to a saturation point. Debt, and as interest rates come down, as equity becomes a little more attractive, as new equity opportunities open up, I think you'll see that pendulum swing back. But for endowments and big foundations, people who had really mature portfolios in real estate to begin with, before entering kind of this post-COVID world, for those who have tried to raise capital from institutional investors, big endowments and foundations particularly, they're full. Everybody says when you call them, it's great to see you and happy to stay in touch, but nobody has any capital. There's been really, and that's not just in real estate. I think increasingly that's the case in venture and in private equity. There's been so little transaction volume, certainly on the equity side of commercial real estate, but really on buyout, certainly on growth equity, on venture. Their evaluations have come down a little bit, not as much as they have in real estate, but there's been almost no transaction volume. And so whether you are a family office like the Agnew company that I work for in Portland, or you're the Cornell Endowment, there's just been very little cash flow in most cases back to the endowment. And when you have a really volatile public equity market, this year has been hugely volatile. There have been periods where equity markets have been way down. Anybody who has a set asset allocation, be it large investor, smaller investor, they're having the denominator effect, right? When their public holdings are going down in value, if everything else stays constant, hugely over allocated. And I think that issue, combined with people getting burned on the equity side of real estate, has really pushed people to pull back. I read a CBRE or JLL report recently. I think that transaction volume is ticking up across property types, multifamily certainly, industrial, but even in the office space, certainly leasing is in many markets has started to come back a little bit. I think there's still a lot more transaction volume on the office side, and endowments and foundations, family offices, a lot of them still have big office holdings that they're trying to work out and extend loans. And that's certainly what I spend a lot of my time on the family office side, extending loans and trying to live for another day, which is great if you're a long-term holder. It's a lot harder to do if you're a real estate private equity firm who bought an office asset in 2020 or 2018 or 2017. They're really struggling. And then, of course, on the multifamily side, anybody who made investments in multifamily post COVID, right? 20 deals, 21, 22, 2020, 21, 22, 23. Those assets, as they're coming back for extensions or refinancings, they're really struggling too. And so I think there is a lot of capital that would love to take advantage of recently it's been more on the debt side, but I think on the equity side as well, taking advantage of what they hope will be really great distressed assets. That's coming out in office. I think people are still kind of waiting for really good value add, opportunistic returns. They'd hope they would be there on the office side on good assets. We'll see if that comes out. But I think for most endowments, most foundations who have mature portfolios, they've put the brakes on real estate, and they're going to do that, and also on venture and private equity and private credit, and still until they see some real cash return. And so, Velocys, with my Velocys hat on, Velocys, is thinking about fundraisings for their various portfolios, getting a lot of traction on real estate secondaries as people, investors kind of get weary in the primary allocation space, beginning to sell into the secondaries. Secondaries are doing well. I mean, I think we're seeing both with my family office hat on and my Velocys hat on, but really also from the student side, and David could speak to this too. There are so many of our students are really focused on housing of some kind, right? And it's been interesting over the last few years. So I've been reading applications. I just read my third set of admitted student applications the last 3 years. And it's really interesting, no matter where you're from, both domestically or internationally, your background, whether you're more kind of development oriented, you're finance investment focused, people are writing their essays about housing and affordable housing. And I think so many of our students, and everybody defines that a little differently, but from someone going to Toll Brothers to someone going to Meritage to going to a small, truly affordable housing developer in New York, housing is a big topic for our students. And I think that's consistent with what they're hearing in the market. So I think that would be one big theme that we're seeing. A lot of people have gone into debt, I think, because of the opportunity set that's been there. That I think is going to start to peel back a little bit. But so those are some of the themes we're seeing. I'm seeing both that are consistent across the educational side and then on the investing side.
I was going to say, as far as the different asset classes where you're seeing allocations, is there anything interesting as far as an alternative real estate asset class or your sub asset class, so to speak, that's curious or that's getting a lot of traction potentially in the housing space?
Well, I mean, for so long, there was a lot of negativity around senior living, right? Everybody thought that, put a lot of money into the baby boomers are retiring. That's got to mean great opportunities for senior living. And 10 years ago, lots and lots of capital went in, and often with pretty poor returns. I think that COVID hit senior living pretty hard. And I think that, valuations came way down. There's been some recoveries, but I think long term, something for dealing with people that are looking increasingly like I do, that is a theme that's going to be there. So I think that piece of housing, I think the at least in my part of the world in New York, there on the housing side, there's a lot of development at the very high end, and there's quite a lot of development in the truly affordable housing, LIHTC driven space. But anything in between is really challenging. And that, I think, it's interesting both with my student hat on, with talking with a lot of our alumni, particularly at CREC, actually, the Cornell Real Estate Council. There's a lot of discussion about how do we develop housing in a more affordable way that is less labor intensive and is more capital efficient on materials as well. So a lot of people are trying to crack that. Nobody has kind of found that yet. Frank can attest to that. Not yet. But there's a lot, I think, to really solve it, for that kind of missing middle, to use a term that gets thrown around a lot. To really solve that, I think there has to be some efficiency created in the building of housing. And so I think there's a lot of scholarship actually at Cornell and other places around. How does that look? I think there's a lot of entrepreneurs. So that is, if somebody can crack that nut in a scalable way, I think that is where there we go.
So what is Cornell's allocation to real estate? And you obviously it's been slow, but are you overweight or are you underweight?
Well, so I'm not at the endowment anymore, so I can't speak for them. I suspect they're probably right close to target. Well, actually that depends. If any portfolio that's had a lot of office, and Cornell, when I left, did not have a lot, and I think was shrinking. It was already beginning to shrink. They're not as hit hard. If you have multifamily, if you have industrial, it's come down, but it's not as tough. But I think there's always a question for endowments and foundations on the private side: are you getting paid for the illiquidity through a big downturn like this? When everything's good, nobody's worried, right? But when you really go through a correction in real estate, particularly in private investing, there's a lot of that discussion. Like why, the median, am I really allocating money to private investments that is really going to generate over a long period of time a better risk-adjusted return than I can get in REITs, for example?
So Cornell essentially focused more on direct investments and funds.
No, we did. No, I mean, most endowments and foundations are not set up for direct investments. They're real, they're not. We had a staff of 20 of us total, and there's no way that we can cover every asset class and do direct investing, right? We could do it if the endowment only did real estate investing, 20 people would be enough. So we did mostly fund investing, but in real estate, took a sector view, and natural resources, infrastructure also in the endowment. So we were willing to move up and down the capital stack and also be in the public markets. And so, a significant portion of our endowment, of our allocation when I was at the endowment was for the REIT space. Just that reason, because we felt like there was a good argument for us to be not just in the private space, but also,
And then there was never any dependence on consultants given you had everything. But
we didn't. I mean, we felt like that was our job, right? Yeah. I mean, we certainly use consultants for data. We used Cambridge for data, that sort of thing. But we felt like the rest of it was our job. But that every group varies. But of course, I think generally the bigger the staff, the smaller the relationship with the consultant.
Right.
Are you seeing from some of the, from some of those endowments and large institutional owners that the office allocation has clearly been decreased, right, over the last 4 years?
You wanted it to be or not.
Right.
I mean,
And now, we keep seeing signs of life where there are larger institutional players coming back and buying transactions. There was a couple of famous ones here in Dallas that traded recently that you know about. Are you seeing that, movement really starting to come back? I mean, is office going to be back from the institutional mindset? Not yet. What's your crystal ball telling you, Kyle?
I think it's going to be really hard for any endowment real estate manager to make an allocation to an office fund. I suspect there are plenty of endowment investors who are happy to do like an opportunistic fund who can go, can find kind of the diamond in the rough in office. But just psychologically, I think people have been so burned that making a specific allocation to office is probably tough. But there are certainly plenty of, I think, if they have the liquidity, people are happy to have their opportunistic real estate manager who can invest across property types, make an allocation to office, buy an office building if they think it's right. But, it'll swing back at some point. But so many endowments and foundations, if you look at their portfolios, their new stuff is in office, but they have lots of legacy, small legacy positions left in office assets. The managers perhaps no fault of their own, have just not been able to sell because of what's been going on in the market. But that's all being flushed. I mean, if you have a 10-year fund and you invested, 8 years ago in an office building and, you can't refinance or refinancing will be really expensive, that pretty soon those assets are going to come to market. And
So create more with more capital. So you said that you see more people talking about housing. You see a lot of students, you're saying, writing more papers about student housing.
and wanting to go into that space. I mean, they're writing their admissions essays.
And so why are they more interested in housing right now? Why is that?
I think I think they see it and feel it. Like, if you are a young professional or somebody, coming out of college and they're trying to make a living, your biggest cost is rent, right? And they're seeing, their ability, whether it's here or it's New York or London or Jakarta, I mean, all over the world, it is really hard to find affordable housing for someone just starting out. And I really think that's why. I think they feel it day to day that this is, how am I, if you're young, how am I ever going to be able to buy, in the US anyway, how am I ever going to be able to afford to buy a house because of where pricing is? And so I really think that's the driver.
Any views in manufactured housing?
I mean, I know there's been a lot of, certainly when I was at the endowment, we saw tons and tons of flipbooks on manufactured housing, and I'm sure there's been success. We didn't do it. But I think that a bigger theme that I related to manufactured housing is the idea of, can we build housing? Can we provide a housing solution that is cheaper, that is quality housing, but do it in a way that is not the cost of carpenters going out and building each single family home. And manufactured housing may be part of that. I haven't looked at any manufactured housing investments in a long time, so I'll let you, man.
Yep. I think it's tough. I mean, from the industrial perspective, certainly not on the these guys' scale, but as a smaller developer, the amount of bureaucracy is what is prohibiting the smaller builds. If I'm going to try to build 7 townhomes or something affordable, the uncertainty and the hold period of which building code I have to go to and which fire compliance and not matching, the electrical code of 2022 versus 24. It is incredibly different. And in my perspective, some of the paving requirements, sprinkler requirements, it is so difficult that the soft costs and the uncertainty is actually a bigger detriment. Because I think we can solve, at least on the commercial or industrial side, we can solve for the hard costs and putting up the metal framing. But how do you solve the bureaucracy?
I think that's a federal question. Yes, I mean, and it usually depends on the jurisdiction. I think sometimes it's surprising that some places you would think have a wonderful, easy place to make investments. When you get down to actually putting up the building, if you don't have scale, the cost of coming into compliance with all the things you just talked about is really high. Let's see that changing. I mean, you saw may have seen in the news California today or yesterday, struck down some of their laws that will hopefully make it a little easier to develop housing. But that's state level. I mean, I think what you're talking about is municipal.
Yeah, we're seeing in Texas. I mean, on the single family side, they have these, state minimums or maximums, right, that try to trample the local jurisdictions to try to create a level playing field.
Is it working?
I don't know.
I think it's hard as the last legislative section. The past couple ones, you got the ETJ pullout.
Yeah.
Pull out the ETJ, be your own, be the county. I think the recent one we just
The
had
multifamily height,
probably worse.
multifamily.
What you can do for offices that you're talking about.
Yeah, multifamily by right in any commercial district without going through rezoning.
All those efforts recently to quash the local governments to not let Fort Worth just won something on the last legislative session. You can't pull out their ETJ anymore because they argue that they have development agreements and you can't do that to our cities. I think some of that's getting pulled back. I think Texas is one of the, I work in California, I've been in Texas. Texas is one of the few states where the state will actually fight for a level playing field.
You need consistency across jurisdictions.
Yeah, their challenge is of course enforcing it, right? Like technically state law can't have design guidelines.
Right.
That was huge.
Every city finds a way around it, right?
Right.
It's the enforcement of that. I think that's the issue. ETJ pullout's huge, right? Like now you can just say, no thanks, city, I'll go to the county. You have options, but then you need water and sewer and all the things that cities provide.
I mean, we build warehouses, and essentially earlier it took 12 months to build one. Now it takes 3 years, out of which 2 years are just the permitting process, right?
So,
I mean, wherever in California is the worst, in Texas and Florida being much. It's also it's good because that's where the migration is happening anyway. But yeah, I think permitting is the toughest part.
So that's New Yorkers about that.
So you mentioned several trends that you see: the debt market being saturated, that you see a lot of attention going towards affordable housing, how to make that possible. I mean, the office market is still reeling from COVID. All these big shifts and changes. I mean, how responsive do you see different people in the market, different groups in the market being? Is there a big lag? Most part, do certain groups get it faster than others to be able to react?
You mean on the investor side or on the general partner side? Well, I mean, I think LPs are always catching up a little bit, right? I mean, and it's kind of the way it should be. The people who should be the quickest to respond are those that are on the ground every day. It's hugely embedded in whatever, sub property type or sub market. One of the things that I think on the education side that's permeating everywhere is, the how quickly we're responding to AI and data, right? Like how quickly should and can the real estate industry move into the, high use of data analytics and AI eventually too. And so there's a lot of investment strategy that's being discussed. Our product is, data. We're hugely data driven. Everybody's hugely data driven. And I think the reality is a lot of people have tons of data, but there's a lot of question about how it's being used. Huge variance in quality. I think there's a huge variance in the sophistication of investment firms, despite what they tell you, of how they can actually use it and what's useful. Do they have? They have tons of data. Is it dirty data? Or is it really noisy data? Or is it data that they really don't know what to do? And so I think, on the education side, we're thinking a lot about one on data analytics. How should we be training our students who are not data analysts, by training, by background, but they need to be able to be fluent in data analytics. That's one piece. But then also the other piece is, most of our students are not going to be going out and developing AI tools for real estate, but they are the frontline consumers of data analytics and of AI tools. It's not the person usually in the C-suite who's they're consuming the output, but they're not using the tools, right? And so we're thinking a lot about how do we train our students to do that? And I think that's if you talk to the C-suite of any real estate investment firm, equity, one debt, that's like one of the top three things that they're thinking about. I think they're scared. I mean, if you told if they were being honest, I think they're worried about, I know I should be doing something, but I don't.
Folks that are just really getting it right.
I think that, there's been a lot of activity on both on the kind of the prop tech side, the kind of the intersection of prop tech and data analytics. I think there's quite a few people are getting it right kind of on the asset management side, particularly in like multifamily, right? Using a prop tech platform and using data to drive renovation decisions, how you turn an apartment after it's been vacated, where where there's a lot of similarity across each of your little units, right? I think there's data analytics can be really good there. I think on data analytics and AI, I think are helping on due diligence. In fact, we were just talking today at Velocity about how are we secondaries business. How can we use, which is hugely data intensive? You're in the secondaries business, you're investing in hundreds of, little slivers of hundreds of different funds. You're getting quarterly capital statements and investment reports every quarter from each of your managers. How do you use data analytics to do that? So I think there'll be more there. I think the bigger question is on the due diligence side, beyond just using data analytics to scrape data off of stuff that, paper or paper equivalent. How do you use that to really drive due diligence and do it in a way, from our perspective as educators, where David knows this, we're struggling with, for instance, financial modeling, right? Forever, if you wanted to go into real estate finance and investment, you needed to be able to pound out, a real estate financial model like that. And that's true in every investing asset class. I think one of the big questions for education on that side is that skill set in 5 years going to be as valuable as it is today? Maybe not, but how do you, when you're building a financial model, so much of the value of that is the assumptions, of testing the assumptions and thinking about how sensitive are different scenarios to the model. How do we teach that in a world where a bot can build a financial model like that? So I think companies, for a variety of reasons, which I could talk about, we're talking to a bunch of companies in New York about partnering with us on education initiatives for the Baker program. And as you're chatting with them, they're worried about that, right? They're unsure about how big do their analyst classes need to be. they're one thing today, are they going to be the same in 5 years? Partially driven by data analytics and AI. I think the idea of educating students about what is coming, I think we're pretty good at, but I think academia is really lagging behind on integrating it into the classroom. Like, how do we, as a faculty member at Hammock, can attest to this too? It's one thing to tell your students you should be using AI, or you should take a data analytics class. It's much harder for faculty members to retool the use of AI in the classroom. It's interesting. Thank you.
Because having guys start seeing it, you might start seeing it soon. Where we keep hearing about law firms with kids that are coming out of law school right now. I don't need to be doing that critical date summary because I can just put that on a model and spits out pretty much better than you can in 1/3 of the time. There's going to be a gap there, it looks like, from someone who's just out of school trying to get that experience to want to be able to understand that what's being done is correct without getting that experience. I mean, that's going to come to a halt pretty soon.
And I don't think anybody really knows the answer to that. I mean, people are experimenting, but on the investing side, it's a big question. How do you really train your junior talent if what you train them on, which is learning by building, if big chunks of the diligence process on a property are run through an algorithm and you have an output. Yes, the output may be great, but are you losing something by along the way of learning and kind of building your knowledge base?
Is any research for university level being done goes above and beyond just AI tools we can all benefit from, but much longer term impact on commercial real estate from the fact that firms probably won't need as many employees as they have now. And not just firms in general, but at every facet of society, how does that impact different asset classes down the line? Is there anybody thinking or doing any kind of work on that subject?
Well, at Cornell, I mean, it would be ILR, the Industrial and Labor Relations. And I'm sure there are faculty members at ILR who are doing some of that research. I think there are a lot of people throughout the university, especially in social sciences, thinking about what is the overall impact on society. And a big part of that is the workforce, or, what is the impact overall of data analytics. On the real estate side, I haven't seen much yet, but, real estate is behind often, right? I mean, you guys know, real estate is one of the last adopters, I think. The industry is one of the last adopters of really data-driven, because for so long, real estate's been a feeling or a relationship, and trying to change that.
There's a secondary impact to what you just spoke about there. Not only are we getting rid of the entry level, the worker bee, so to speak, like replaced by AI, but AI hallucinates. How do you quality control AI?
It's so way beyond my pay grade. I think yes, it's a huge issue. I shouldn't give you the impression that I think those junior jobs are going away, but I think they're really changing. And in real time. It was, I don't know, David, was it 2 years ago?
The adoption.
Yeah, so I teach a real estate transactions and deal structuring course. A lot of students, David included, take in the second semester of their first year in the big group. It's a 4-semester program. So in that class, ChatGPT came out in October, November of 20. Yeah, and I'd heard about it, and then I went off for Christmas vacation and didn't really think about it. And then my class started in January, and the first assignment I assigned came back. I was like, oh my God, half the students, not half, but a good 20% clearly used ChatGPT. And I looked at the syllabus and I said, well, there's nothing here that says they can't do that, right? And it happened that fast, right? And that was 2 years ago. Think about what's happened in the last 2 years. Tremendous adoption. So I think we're very early on, but I don't think those entry-level positions are going away. I mean, Anna's probably knows better than I do, but I think a lot of faculty members are trying to train students up for, if you're going into consulting, some of the really grunt work of writing and drafting, that's going to AI. And the job is changing from, writing out a perfect, bespoke, quarterly report to plugging it into an AI tool and checking.
Let's give away to those 20% of the students that were using AI that way, but they all had roughly the same.
No, so that was too good. I don't mean it was too well written. So the exams and the assignments I give are really time pressured. And so they don't have time to write a perfectly beautiful, response to a short answer question. And they came back, grammatically absolutely perfect.
Eloquent.
Yes, and with beautiful introductions and summaries. So that was the giveaway. But if I were a professor of English or a social sciences professor, how do you evaluate? It used to be you write a paper, right? And yes, you could cheat doing that. But now, how do you really assess somebody's work if they are using a chat tool? Now, in reality, they're going to use that in their professional lives, right? So we want to train them for that. They also need to know how to write and reason. In an educational perspective, how do you train them up to do that? And then also train them to use a chat, an AI tool in the workplace. So I don't think higher ed has the answer to that.
Yeah, I think the training itself is really important. When, I was out there recruiting, and they give me like a case study to perform under like 1.5 hour. Would I have the time or integrity to use the AI in front of them? And at that point, you have to perform professionally and showcase them. Hey, I can do this case study, written it in plain language, not as such as the level that maybe ChatGPT could live up to, but still trying to get that part of education. I think it's really important. And totally, I can second what Cody mentioned about. There's a lot of things you can pick wrong happening in so many real estate programs out there. But what the program have been trying to train us is to understand how the real life real estate works, and how they teach you is how are you going to pick up in the real life real estate by habitually telling you pieces from here and there, and you kind of put it together, which is how it really happens in real life. So I really enjoy that piece about the program.
I think in my transactions class, just as an example, one of the ways I'm trying to deal with that is making people present, right? Because it's one thing to churn out, a paper. It's another thing to have to really talk about it in class. And so I think that's one of the ways that you can really test someone if they're having to think on their feet and answer questions and they don't have a second to put it into a chatbot. I think that's one of the ways to deal with it.
So you mentioned earlier, not much deal flow right now. What do you think when this is sort of cleared out? Is it going to be people jumping into, do you think housing, maybe not like retail, like malls, maybe not offices, but want to get a sense for maybe what people kind of want to do but don't?
I think the demand for, look, I don't have any proprietary knowledge, right? But you're seeing, even though apartments and multifamily have taken a beating, one, they took a beating, before interest rates went up because cap rates were so low and the ability to really make money there was pretty thin just before interest rates turned. Now, those deals, people are struggling to refinance them. But I think those dynamics will pass. I think there's a ton of investor demand for multifamily still. I think people view it as a relatively safe way to invest their capital. And I think that will continue. There's been overbuilding, but that's getting worked through pretty quickly. So I think housing is a need that is going to be there long. So finding, whether it's multifamily, whether it's senior living, whether it is single family homes, whatever. I think the housing question, when our students ask me, where should I focus? Somewhere in the theme is up to where I put to go.
What kinds of strategies do you see family offices, endowments using to kind of predict where the market's headed right now? What's the information? How are they processing it?
I mean, I don't know that. Certainly, the investment houses, right? They have their own research staff. They're doing proprietary research, doing heavy data analytics and really coming up with investment house views that then drive their investment teams. Big, like an endowment with a staff of 20, right? We are consumers of that data. My job at the endowment really, real estate, natural resources, was really to consume all of that data and then use it to come up with an investment theme. I think increasingly endowments, and foundations, big investors who are diversified across lots of asset classes, they, increasingly have a lot of data of their own. There is, an increasing desire on the part of institutional investors like endowments to take the data that they've got and try to pick investment themes from it. I'm not sure most endowments, except maybe the very largest ones, will really have the people power and the ability to really invest what is a very expensive endeavor to get the best data and the best data analytics teams. I mean, I think there will continue to be demand for that outside parties. But so few endowments. I mean, even Bridgewater, right? The classic example of the most data driven hedge fund business out there. No endowment will ever recreate something like that. So there will always be need for someone else doing that.
Have you seen, with your clients and endowments, et cetera, a change in investment hurdles for deals recently? I mean, has been so much money and equity sitting on the sidelines for the last 3 years. I had a conversation yesterday with a long-term insurance company who was saying they lowered their hurdle on this type of project, down in what it is, by 100 basis points because they cannot make things work and they need to put money out because they've been sitting on the same funds now for 18 months without deploying $1. And now they have 15 months, 16 months to deploy $1.6 billion, and they just have to get deals done.
This is on the GP side.
They are an LP investor.
Fair enough. Yes, I mean, that's always the issue, right? I think, anytime that you are investing in a closed-end fund structure, either as a GP, or as a limited partner, just the nature of the time limited nature of that, both from the LP and the GP perspective, either you need to get money back in or you need to get money out. And I do think it warps the kind of the investment decision. I mean, real estate really is a long-term, illiquid asset class. But I think that time pressure is very much the case. And so not a lot of people have raised a lot of money in real estate in the last few years. But, if you, let's say you were a new family office, right? You had some kind of liquidity event and you needed to get, you had set an asset allocation and you needed to get up to a target. You're going to be pressured by your investment committee. If you have no real estate today, and you have a 5-year asset allocation that says you should be 10% in real estate, you're under some pressure to allocate. And if the investment environment is not favorable or not as favorable as you might like, you're still under pressure to get invested. And so I think you saw plenty of GPs putting out a lot of money into multifamily, even when cap rates were really compressed. And I think it was that reason, right? They had invested the capital. They had, a 2, 3, 4 year investment period that was going to terminate. They're making money on asset management fees. They don't want to send the capital back. So I think good GPs don't really do that, but it's certainly part of the calculus in the back. And I think it's either overtly stated or just sort of unintentionally, I think you do start to lower your standards a little bit to be able to get a deal done.
David, Cody, maybe could you share a little bit about allocation across geography? I wonder, what's the past 2 years allocation has been across APAC or Euro or here in the States?
I'm not the right person to ask anymore. I used to be. I think certainly appetite. 10 years ago, there was so much pressure on endowments and big institutional investors to be much more active in Asia. We were always looking at, the MSCI, right? And what MSCI world? What is the world allocation to the various geographies around the world, various countries around the world? And if you looked at MSCI world, let's say take the China allocation, right? It's a big chunk of the MSCI world. And if you looked at your own portfolio, you would see the vast majority of investors were way under allocated if you were using that as a benchmark. And so I think people were thinking about that as a proxy for a global market. We should be putting out a lot of money into Asia Pac. And so I think, 10 years ago in real estate, yes, there was certainly a lot of activity in real estate, but really on the private side, really buyout, growth equity, a lot of money went into Asia Pacific. So I don't know. Right now, I think there's certainly in real estate, we're fortunate in the US because it's a big, diversified market where cities really don't act in a correlated manner, right? And their property types, there's plenty of innovation, and we're still growing, the population is still growing, economy's changing, which affects real estate. I think most domestic and domestic investors that have a sizable real estate portfolio, I think the vast majority of that is still in the US. And I think they're really reluctant. I would be very reluctant to think about what's the risk return, right? Are you really, I would be all for allocating to, investments in China or wherever else, you were really getting compensated for the risk. But I think it's really hard to assess what is that risk, and particularly around, you can always get your money in, but can you really get your money out? And are you being paid for that relative to going out and buying, if you're looking for opportunistic returns, going out and buying a portfolio of distressed office loans, right? If you're getting those at the right price, US office loans relative to putting out equity into a market where you're worried about getting your capital out.
Historically, at least the last 10 years, we were the safe harbor, plus a very large market, and currency was doing well and so forth. Now that's changed. Are you hearing anything about that?
I think it's early, but I don't know. Does anybody invest internationally?
It's by accident for the portfolio and the family. That's not new money that invested overseas.
And David may have a view on this, but I still think most non-U.S. investors view the U.S. as a safe harbor. Certainly in real estate. If you think about where cap rates are still relatively low for truly trophy class A assets across property types. And, the good ones are cash flowing and they're able to get debt. And so I don't really think that has changed. I mean, remains a liquid market. It's getting more liquid as transaction volume picks up. If you really want out, you can sell in the secondary market. I think most big sophisticated investors still think the U.S. is a safe haven market. I'm sure they're thinking about, is it as safe as it was? Right? Is it really safe relative? Yeah, I think it's all relative. Right? I think the U.S. They're recalibrating their view on the U.S. I think they're also recalibrating their view on lots of other safe haven markets, and I'm not sure in the end that the U.S. comes up on the short end of that stick.
You just have the added risk of foreign exchange. So, fundamentally, I agree.
Well, I mean, if you are putting new money into the U.S., your dollar, your pound, or your yen, or your euro it's buying a lot more money, buying a lot more. It's painful if you had dollar assets and seeing them come down. Right?
Well, thanks, Cody. I hope you enjoyed that talk and a little bit more about myself. I'm a commercial real estate attorney. I'm also a large investor into industrial commercial real estate here in the Dallas area. And what I really hope to take away, and I loved Cody's discussion because he showed his slice of the world, his view of what he sees in the capital markets, as well as the private equity and the endowment side. And that has real impacts on everyday investors. And I'm going to incorporate some of that into my own investing. So smash that like button if you're still watching, and we'll see you next time.